Hello, my name is Brian Overby, and welcome to Options Guy TV. I'm going to be your host here for about the next 25 minutes or so. We have a couple adjustments that we need to make in a couple of trades that we looked at. I was thinking about coming in today with the plan that I would be adding a few more positions into our paper trading account, which is all about deep in the money option contracts and selling shorter term calls against them inside the options playbook, which I authored. We call that strategy the fig leaf. But on Monday, we went and put on a long put butterfly trade in the SPX. The market has been strong since then. We're kind of looking for neutral to downside movement, and we've had a fairly strong market. The market did come down closer to our strikes for a minute or so, but now has gone back up. And that has given us an opportunity to actually learn an adjustment in a butterfly on a short-term trade. So even though you prefer that if you're looking at trades that they always work out and that you're correct on the direction, but we can learn a lot more from a trade that has gone against us. So we're going to spend some time today looking at one of my favorite adjustments inside a butterfly on a shorter term butterfly trade, part of the speculative portfolio that we do here on Options Guy TV. Now, as usual, it's not meant to be a recommendation, but these concepts, we're going to look at it in the SPX, but they can be applied to all sorts of underlyings and all sorts of option trading. In general, with butterflies, I kind of like if a butterfly is really just made up of a long call or long put spread, and then combining that with a short call or a short put spread. So it's really just two spreads that make up that butterfly. And because of that, you can leg in and out of those spreads. And that's what we're going to do today. So I'm going to show you how we would leg out of our SPX butterfly. And to be blunt, for quite some time, most of the month of December, we looked at doing a lot of butterflies, but they were all going in the right direction. So we didn't really have any issues, and you need to adjust. And if I am adjusting a shorter term trade, I really only want to make one adjustment. Bid-ask spreads, well, commissions in this day and age are much better than they ever were, but you still have fees involved with trading options. And the bid-ask spreads in general, if you're adjusting a lot, you're battling with the market makers to try to get midpoint fills and better fills on it. So I prefer to just make one adjustment, and then we're going to let that trade ride. I'd close it out to manage risk, but I don't want to continue to adjust over and over again on a 1 week trade. As a matter of fact, this is going to be a 5-day trade. And then last week we looked at IWM, and IWM we did a long straddle. As a matter of fact, back in the day, about a month and a half ago or so in the IWM, and I'll show you that chart and we'll talk a little bit about that. That is the ETF that tracks the Russell 2000 index. There was a defined channel without a doubt in IWM, and we are on the lower end of the channel, and we saw we ended up doing the long straddle there, wondering either if it would break out of that channel to the downside or bounce and come back up. That was a very strong trade. As a matter of fact, did extremely well, and the market moved right at almost instantaneously from the point that we put the trade on in one direction, and that's all you really need with a long straddle. You need it to move, but you need it to move in one direction hard. And this time around, now we're on the upper end of the channel. We had a little bit of a breakout, but it was a head fake. And now the market has been volatile in IWM, or the Russell 2000, or the small caps, or however you want to say that. But unfortunately, there's been a lot of volatility, a lot of price swings, but the market has came right back to where it was when we first put it on. We still have some time, but we're going to also look at that trade today. So that's going to build out Options Guy TV for the day. And as always, if you're on the YouTube platform and you have access to the chat box, please feel free to participate. Options Guy TV is all about participation. This excellent format allows me to address any questions that you may have. So throw them in the chat box if you get them, and I will try to address them at some point during the show. Okay, so let's go into the SPX trade. Now, on the SPX, the expiration that we have is what? Well, let me go look at the what if calculator. Let's go up here. Is the 12th, which is just Friday. Yeah, that's right. So 2 days away is that expiration date. This is the butterfly that we put on. This is as of today. We put this butterfly on for $2, and it is now trading for $1.33. Now, here's the question. Do you want to stay the course? The market has moved strongly to the upside. We had some volatility. We came back down, but now we've gone back up again. So much like the Russell 2000 index, where we actually have a lot more risk because we were buying premium, so we needed to move faster. And a butterfly time decay doesn't hurt you as bad. But now would be the time to adjust. I've talked a lot on Options Guy TV about what happens in particular in the SPX options. You can look at theta and you can look at all of the theory behind the options contracts. But just from pure experience of trading the SPX, from Wednesday to Thursday, you get a boatload of time decay. Like, it really hurts these expensive option contracts. And they're expensive mainly because the underlying is expensive. Implied volatilities, you can look at the VIX and see where they're at, 30-day implied volatility right around 13%. So implied volatility isn't huge in most indexes, and that's intended. That's why people like to be in indexes, is it dampens, it diversifies your trading, and that dampens volatility. But with that mentioned, in the SPX, we've had a nice move down and then a move up, and now if we're going to adjust the trade, Wednesday is a good day to adjust the trade. And I think since we do Options Guy TV at 11 a.m. Eastern time on this Wednesday, the time is right to make an adjustment on the trade. So here's where the butterfly is at, and this green line represents, if you bought it today, what your profit and loss would be. Now, the underlying market is all the way up here, 47.67. When we did it, it was right around 47.20. So we are now 47 points above where we were at. So what we're going to do to adjust this trade is we're going to sell the most expensive option contract. And then buy another option contract to roll into a short put spread. So since we are short two of these, and this is one adjustment that we can make, we can do something a little bit different if we would like, but these are puts, don't forget that. So we're going to sell the most expensive, which would be the 720 strike put, and that's trading right now based off of the theoreticals right around 485. Because this is inside the what if calculator here on the TradeHawk software. And then we're going to use those proceeds to buy this option contract. And hence, we're going to add some risk. We're going to be into two short 20-point wide put spreads. But the market is going in this direction to the upside, right? It's going up and away from our strikes. So you got some momentum in that factor. And when we do this, now the most important strike, we don't want it to get down to the 4,700 level. So we'll be in a short put spread, which means we want the market to stay where it's at or go higher. If it starts drifting down, there's risk, but the risk doesn't actually start killing us until we get to the short put strike of 4,700. So if we look at this trade, what will end up happening is we'll get rid of this. If I can do that. Well, let me go in and do it and show it. Let me show it this way, okay? Because every once in a while, I will get a little bit slowed up when I'm using the StreamYard. So here we go. We're going to send this ticket over here. Okay. So here's the goal to this trade. And here's the reason why I would want to adjust it today. We paid $2 for the trade, and we haven't lost a lot. So you could just get out. It's trading for 152. So there would be a little bit of leeway, but we're taping the show at this day at this point in time. you're only down 50. Now you're down $1. Actually, it was 50 cents, but now you're down $1. So now you're down about $1 on that trade. We paid $2 for it. It's now trading for $1. It was closer to $1.50 when before the show started. So the market is up 11. It's 47.67. Okay. Now to do this trade, you're short these two. We are going to, and I'm going to remove this because this is what the adjustment would be. Now remember, we'd have this position on in our account in theory, and the adjustment would be that we are going to sell the most expensive option contract, which would be this one. Now it would be to close, but the software won't allow me to do that because this is a test account and that position isn't actually in there. And then we're going to buy to open the 460 account. So now, right now, that's bringing in a net credit of $3.40 to the account. Okay, so if you do this, you have to be you have to feel good about the market staying where it's at or going higher, because you're going to be adding a lot more risk to the position. You're moving from the nice and safe butterfly that had limited and known risk into two short put spreads that are 20 points wide. So the requirement will be $4,000 to do that. You're fairly safe. You have a fairly low probability of the underlying getting to that price, but you still need to manage that risk. There's still a possibility that it could happen. So in this instance, the 4,700 strike here, we see the delta is at 10%, right? So the delta is minus 10 on the put side of things. And remember, we're dealing with puts here because we were initially bearish. And right now, with the delta at about 10%, they're saying there's a 10% probability that the 4,700 strike finishes 1 cent in the money. So let's do the math here. We put the trade on for $2. We could take it off and we could lose $1 on the trade. So we put it on for $2. We were trying to make $4. There might have been a possibility that we could have got out for $4 because the market did come down for a minute if you look at the chart. But more than likely, you probably rode it through that trade. And now, instead of just closing it out and losing that $1, we're going to make an adjustment and we're going to add some risk to the trade. So we're still going to manage this risk, but now we're just hoping that the momentum to the upside holds for another day or two, at least one more day. That would actually give us an opportunity to get out and we get that huge rate of time decay. And right now, from Wednesday to Thursday and Thursday to Friday, those option contracts got to go away by the end of the day on Friday. So big time decay over the next 2 days, especially in the SPX options, which is a 4,700 point index. Okay, so how would I do this then? I would enter this trade. I'm selling to close the most expensive option contract, the 47.20, and buying to open the least expensive option contract, the furthest out of the money one, the 46.80, doing this for a net credit at this point in time of $3.70. We paid $2 for it. That means that we now have a possibility, if the market stays above 4,700, that we can make $1.70, or for our whole gaggle of securities that we started, we're looking at making $170 versus losing that $1 on the trade. Now, you got to have the margin to be able to do it. And if you do roll into this, the painful thing is that you are then going to be short 2 short put spreads. There's a different adjustment that you can make, and that would be a more so I just want out. I don't want the cheese anymore. Just let me out of the trap. It would be more of a break-even scenario if you did that. But in that scenario, what you're doing is you are selling the most expensive one and then buying back one of the short option contracts. You would still bring in a credit. It wouldn't be as big of a credit, but that is another adjustment that you'd make. And then that would only leave you with 1 short put spread or one $2,000 requirement. Okay, so this is the trade. If you want to look at it, screenshot. If you got any questions, feel free to ask. This would be sell to close, buy to open, net credit Now it's 380. We'll put it at 380. Let's keep it 380, and that's going to be the paper trade. That's going to be the roll. This is what we're going to look at. And so we put it on Monday. Market kind of came down. There might have been an opportunity to get out, but odds are we probably didn't. Market is now going up, and it's now showing some strength. We're going to ride into that strength, and we're going to go from being a little bit bearish to now being a little bit bullish with a short put spread, and we're just hoping that the market doesn't come back down against us. My next trade is that I'm out of the trade. I either let it expire worthless, buy it back for pennies if I can. If that happened tomorrow and the market was up another 20 points or another 1% tomorrow, I would be interested in buying it back at a dime or a nickel. That would be great. But if not, if it starts coming back towards my short strike and it gets very close to the 4,700 level, I'm just going to have to take my comeuppance, right? I'm going to have to get out of that trade and move on. Don't let it get in the money. Don't let it go strong against you. But you think about it, you started with a situation where the market stayed where it was at, you were okay. If it drifted down, you were great. If it went up a little bit, okay, now I can think about what I want to do with the adjustment. Now it's gone up a little bit more. So now the momentum's to the upside. So let's just flip this trade with one simple little roll and bringing in a net credit to the account. And then you're just, hoping that the market will continue in the same direction that the momentum is taking it. And it's one of my, on a speculative basis, when I'm a little bit more neutral in the marketplace, I like to look at this trade and doing this trade. I like the concept of rolling in and out of butterflies. So you can also do it the flip side. If you're long a call spread or long a put spread, you roll it into a butterfly if it's going against you, and give yourself a chip in a chair and a chance to be able to get out of the trade at break even or a small profit. In this instance, it would be a decent profit, $1.70 or $170, but you do have a lot more risk that you're adding to the trade. So let's go back to the what if. Well, actually, you know what? Let's jump out and let me show you what I mean inside the options playbook. So let's come out here for a second and let's take a peek at the options playbook. And the playbook is fairly easy to just kind of walk through what makes up a butterfly. Okay, so with this instance, and I'm showing you the long butterfly spread with puts inside the options playbook. This is the companion website to my book that I authored. And we're showing the long butterfly spread with puts. Now I started the show, I kicked it off by saying it's really just a combination of two spreads. So right here, if you notice on the at expiration, here's the profit and loss graph. If this was a short put spread, you would come up, you'd have the limited risk because you're buying a put down on the downside, slide all the way up and then all the way over, and this would be the short put spread. So here's what the short put spread looks like. Now it's tweaked a little bit because we're saying we're getting a little bit of a smaller credit, but that is this part of the butterfly. All right. Now you combine this trade with this part of the butterfly, which is the other spread. So from strike C on down all the way to here, and then it would continue on up, and that would be the long put spread. So if I do the short put spread and I combine the long put spread, I put it all together as one trade as three legs, and you come up with the butterfly, the limited risk scenario. So what we're going to do is basically come in and do this, a version. We're going to roll into it, and we're going to end up with a trade that looks like this. That's just the short put spread. And we're going to be short two of them, though, in this scenario, if we go through the trade this way. So let's go back now. That's how you would work through it inside the options playbook and just looking at the basic strategies. Now let's go back to the real market and the TradeHawk software. Here's the roll. $3. Now it's moving a lot. So $3.80 is where we were at. We said that's where we would have did the roll, and that would have been the net credit to the account. Now, if we change this back up, and let me see if I can, if it'll allow me to get rid of that. No, it's not doing it. Okay. So I am going to send this back to the trade ticket, and let's start with that original position. Now, little different adjustment, little different. And it's all about the risk tolerance that you have. I like the adjustment that I showed you, but some people aren't comfortable with the fact that you went from $200 the risk to now have $4,000 of risk, and you have 2 full days of trading the SPX. So that is risk, even though it's a high probability of success trade, low probability of the market getting down to that 4,700 level. If I look at this trade now, the next trade would mean that we're going to do this. Okay, so we're going to ignore this leg of the butterfly. So I'm going to remove it. All right. It froze for a second here. And when there we go. Good. Okay. So I removed it and it shows it up here in the options grid. And then in this instance, we are going to be buying back 1 contract. So notice we were short 2. We're going to do 1. So what would happen here is you're doing a buy to open. And I got rid of the wrong leg. I'm going to move this around. Let's go here, 720, more expensive option contract. And we're going to click, this is asking price. This would be open. Sell to open. Okay. So now, if we did this, remember, all 4 legs, the 3 legs that were in the trade were 4720, 4700, 4680. So we're not going to mess with the 4680. That's still out there. But if we take off the 1 spread that has helped us in this scenario, the market has gone up. This is a short put spread. So if we sell this, we sell the 720, the most expensive, and we buy back 1 of our short options on this 4,700 strike. Now we can bring in a net credit of $2.25 to the account. If we do that, we are then short 1 put spread. We are then short 1 put spread as opposed to 2. We only brought in, and this is interesting because this is actually a time when I would do it. We paid $2 for it, and it's $2.25. So I'm not worried about where the SPX is. Well, you are in theory because you're obviously got risk, but I'm doing this trade right now because I can still get this done and have a small net credit that I put on for the entire trade. So if I do this now, I was down $2 on the trade. I can sell it for $2.25. I can roll out of this put spread, the long put spread side of things, and bring in a net credit of $2.25. That means net on the whole gaggle of securities, I'm up a quarter if the market stays at 47.64 or goes higher. Like if it just stays within that range, it's not as enticing. The other one, I could made a $1.80 on it, but I would have double the risk on the downside. So this is another alternative. Okay, so let me go back because I kind of screwed that up from the what if calculator, and I'll show you. We're going to go back to the initial trade. Let me send this back to the ticket. And what will happen is this trade, we're going to ignore the 4680. Yeah, we're gonna ignore that trade. I'm selling it to myself. So that goes away. We are going to sell this to close, and this would be buy to close in this scenario. Oh, and I got one more. That's where my situation is. And we're going to only do one of them. And then we bring in a net credit of $2.30 to the account. That's simple. These are my favorite adjustments on my short-term speculative butterflies. It's all about how I'm feeling about the market. If I'm feeling fairly strong riding into Friday, I would roll into the 2 put spread scenario. as opposed to just closing this out and then just saying, to me, this trade is, I don't want the cheese anymore. Just let me out of the trap. And this would be the second adjustment that you could consider. And right now would be the time to do it, because the adjustment is $2.30. We paid $2 for it. We still get 30 cents net credit if everything all works out in our favor and the market does not come down to the 4,700 level. So when that's all said and done, by the way, this one goes away. Okay. So the 47.20 goes away, and we are just long one. We need to buy this one. We're long just one short put spread like that. And that would be our position. All right. All right, I got a few more minutes. If you have any questions, put that in the chat box. But I want to go back and go to the what if calculator and just show you the long straddle that we also put on. Okay, so I think in the IWM, the chart is more important. We did do a good trade in Lilly the other day. Lilly just had, they're going direct to consumer, and they had some positive news. So the market is up towards all-time highs. But I digress. IWM. Okay. So this is what I'm talking about, the volatility. We've had very volatile markets, and this was kind of the breakout and head fake. Let's go 800 days, kind of show you what I was talking about at the top of the show. See, look at the highs and lows, how it was just trading so nicely, which the Russell 2000 doesn't always do. And this was kind of a head fake. Right here was the top of this candle, and right in this area, a lot of congestion. Thinking maybe we broke out on this. Didn't happen. Now, once again, we came down, a lot of volatility to the downside, came all the way down, now all the way back up, and we're right back to where we started. IWM, I'll put that in here. So we see it at 194.41, and when we put the trade on, we were at 194.06. The straddle is now trading for $5.40, and we put it on for $6.30. We are going out, and this is the wrong expiration, but we have the 119 expiration, so we have 9 more days. So I'm definitely going to ride this for a couple more days in IWM. Like I said, the volatility is there, but unfortunately, it's been going down and then coming back up, and then going up and then coming back down. We needed to decide: are we going to break through the resistance to the upside, or are we going to go back down into the channel and hopefully go back down into it hard? And that's where the IWM is at. And that's that simple. And I think we are at time. So thank you once again for participating in Options Guy TV. We'll see you this coming up Friday at 11 a.m. Eastern time for the next edition of Options Guy TV. And, let me know in the comments. Let me know if what you thought of the adjustment in the SPX. Thanks for coming, everyone, and hopefully we'll see you soon.